So the indices are probably the most popular markets on the platform at the moment, mainly through the market movements in them. They represent a weighted index of the top 100 FTSE shares, the top 30 German shares, the top 30 US shares, and are perceived as quite a good reflection of how the underlying economy is doing. And certainly this last year, the story has probably been the macro story of the world markets. Indices are a good reflection of how those economies are doing. Well, the calculation is basically similar. Obviously, the stocks that go to make up the Wall Street or the German DAX or the FTSE 100 are different, but the actual calculation process is a similar base. I think the key issue is the fact that you need to know. I think it helps to know the underlying makeup of that index, but I don't think that's the be all and end all of trading that index. Well, we have the advantage of that is a commonly formed calculation. So there's an underlying price, particularly from the futures market, the exchange traded derivatives markets, which allow us to add or subtract a fair value to generate a cash index price. So the actual hedging ourselves using a cash index is very hard to do because you have to do a trade-weighted, volume-weighted split between 100 stocks, for example, in the FTSE, whereas if we trade the FTSE future, it's a very liquid, very tight spread, which replicates exactly the FTSE 100 index. Interestingly, they are probably more volatile on a day-to-day basis. On an overall movement for a longer-term position, many stocks will outperform or underperform the index. So if you're running a position for a month, I think a stock-specific choice of trade can generate more or less income out of it. Whereas on a day-to-day movement, we quote a lot tighter price on the FTSE 100 or the UK 100 index than we do on a relatively much tighter price than we do on Volatile, for example. So for a day trader, I think the index is the one to go for.